So in this video, we'll be going through deductions. Now, let's start from the beginning here. So what is a deduction? So deduction is what you offset against your assessable income to calculate your taxable income. For example, if I've got a salary, I might deduct working expenses, and I would only be taxed on the income net of those deductions. Now, deductions are dealt under Division 8 of Income Tax Act 1997, and there's three specific sections which we can cover off. So one is Section 8-1, and this is a general coverall section, and it's for general deductions. And if you're not sure what section reference to apply in your exam, you just want to use Section 8-1. Now, Section 8-5 relates to specific deductions. So these are things which don't generally fall under these rules, but are specifically listed as a deduction. And the last one is Section 8-10, which is anti-double counting rules. And this is just where multiple provisions allow deduction. It's just to say the most appropriate deduction rule applies. Okay, so let's go into the first one, which is general deductions. So that's Section 8-1. So Section 8-1 says that a loss or outgoing is allowed as a deduction, i.e. you can offset it against your income, to the extent that Section 8-1 has positive limbs, so you must satisfy one of these positive limbs. So Part A is saying it must be incurred in gaining or producing your assessable income. Okay. If that doesn't apply, the other option you can use is necessarily incurred in carrying on a business for the purposes of gaining or producing assessable income. So in short language, it's saying you must have either been in relation to you earning a salary or other assessable income that you've included in your tax return, or it's been in the purpose of carrying on in the business for the purposes of gaining or producing assessable income. So you don't necessarily have had to have earned income, but you are carrying on a business with the purpose of producing assessable income. So you can still have a deduction even if you haven't earned business income. But if it's something else like salary or dividends, etc., it must still be in your assessable income for you to use that deduction. Those are positive limbs. So positive limb is basically something that you can include. A negative limb means that it cannot be any of the following. So if your deduction falls under any of these subsections, you cannot include it as a tax deduction. So the first one is 2A, is outgoing is capital in nature. So for example, you might have spent money, even though it's incurred in your business for the purpose of producing assessable income, you might have spent that on a building. So a building is capital, it's not an expense. So the way you would treat that is you'd capitalize an asset, and once you sell it, you make a capital gain, that would be your cost base. Form part of your cost base, and you pay less in capital gains. So that's the first one. The second one is outgoing is of private or domestic nature. Okay, so it can't be personal expense or private. Section C is saying outgoing is incurred in producing exempt or non-A income. So non-A is non-assessable, non-exempt income. So it must be in your tax return, and it must be in relation to assessable income. It can't be exempt or non-assessable, non-exempt, because then you're kind of double dipping there. And the fourth one, D, is outgoing is prevented by a provision of the income tax. So this is just a general provision saying if there's another provision out there that prevents it being a deduction, you have to you can't include it here. So there's a bit of a flow chart here you can follow. Is there a loss of outgoing? Yes. Is it incurred? And incurred we're defining as either carrying on for the purpose of a business or included in assessable income. And then you go through, does it get caught by any of the negative limbs, which means you can't deduct it if it is. So if you've gone through all of these, then does the expenditure only partly relate to the positive or negative limb? So you must apportion it. And if not, it's a full deduction available. Okay, so let's go to that first positive limb now, kind of go into a deep dive of each of these. So for the positive limb, the first one, what's the definition of incurred? Because this is saying incurred in gaining or producing your assessable income. So what is incurred? So incurred means you've had that expense. So does that mean you've paid it? What does it mean? Does it have another meaning? Well, it doesn't necessarily mean you have had to have paid it, but these are good indicators that an expense has been incurred. Okay, so has it been paid? The taxpayer must definitely committed or completely subjected to pay. So you might not have paid cash at that point in time, but maybe you've signed up an invoice or a contract or something like that, which means you will have to pay. So you can still have them incurred. These are the relevant cases over here. You want to reference back in an exam too. Number 2, insurer provisions are deductible. Okay, so that's a specific one. Actual payment indicates it has been incurred. So this is just saying that if you have paid it, this is a good indication. It doesn't necessarily mean it has been incurred in that period. Consider the context of like a prepayment or etc. So you've got to consider the timing. Present liability. So this is another question you have to ask in determining whether or not something's been incurred. Is there an existing liability in that period to pay the sum of money? Estimated. So can we reasonably estimate it? Dispute. So not deductible if there is a genuine dispute over liability's existence. Right. So that the outgoing must exist, and there can be no question about the existence of this liability. Otherwise, it's not deductible. Okay, and then here's some specific things. So around interest expense, is interest expense deductible? Well, you got to consider the use of the funds and also the purpose of the funds. So the use of the funds, has that been used for the purpose of gaining your assessable income, or has it been used for the purpose of carrying on? For example, you've borrowed money for a rental property, but then you use half of it to purchase a new car. Well, you would only be able to use half of it, the half that you haven't put towards buying a car, as a genuine deduction, because the use/purpose of that money was not for gaining assessable income. And it's just talking about here how it must be a portion where used for different purposes. That's where you'd bring in this case over here. So it's quite complex, but you can only deduct the portion which satisfies all of the general deduction rules. Okay, what about the second part of this incurred limb here, section 8-11B, which is carrying on a business. So how do you know if you're carrying on a business? Because this can be quite contentious if you haven't made any money but you want to claim the deduction. Well, you can't claim it under A, but under B you might be able to claim it provided you are carrying on a business. So what is a business, and how do you know if someone's carrying on a business? Well, here are some indicators. 1, activity is regular. There's profitability in the business. Things are carried on a business-like matter, like you might be having meetings, you might have incorporated a company, you might have an office, etc. So you might have those expenses going out, but no revenue. That's okay. You are still carrying on a business. Size, scale, and permanency of activity. Have you been doing this for a long time? Have you employed a lot of people? Do you have multiple offices? Okay, cannot just be described as a hobby, recreation, or sporting activity. A good example of this is share trading. So, for example, you may be trading shares on the side. And this is a very common example because, especially back in the day before capital gains existed, people would want to treat their share gains in a particular way for tax purposes. So they try and argue, they might have today they might have tax losses under their revenue, but they don't have capital gains losses, something like that. So they want to do it one way or the other, either capital or income. So what they'd try and do is they'd argue that they're carrying on a business for the purposes of share trading. Well, they'd look at this and say, well, are you trading the shares for the purpose of running a business, or are you running it as a hobby, like a side? We'll say, well, you're only doing it once a year, one trade a year, so it's not really a professional business. Most likely this is a hobby or recreation. Okay, so let's move on to negative limbs. So just to remind us what negative limbs are, so these are the rules that if the deduction relates to any of these, there cannot be a deduction, right? So, capital in nature. So how do you know something is capital in nature? And we'll discuss about this a lot later when we get to it. But there's some very general rules around the difference between an expense and capital in nature. So here are some good indicators from the Sun newspapers case. One, there's an enduring benefit. So, for example, if you're bidding a factory, you're not going to have a one-off benefit. The factory is going to be around for a long time. It's going to be producing equipment for a long time. So it's going to be enduring, i.e. long time, and benefit. So there's going to be returns from this in the long term. So once and for all versus short term. So how long is this kind of benefit going to be around for? Is it a one-off expense? For example, you might have hired a contractor, so that's going to be one-off period. Or are you, a good example, I used the example of the factory before. So is this factory going to be around for a long time, once and for all? Lump sum compared to a series of sums. So the regularity of payments, for example, if you're paying someone a salary each week, indicates that that's an expense. It's not capital in nature. However, if you're paying a $5 million lump sum for a building, that kind of indicates that it's capital in nature. Okay, and the other ones, the other four negative limbs are quite explanatory. So private or nature, you should be able to determine whether something's private. Producing exempt income. So we talked about this a little bit in chapter 1 under income. But we will return. So here's some examples of exempt income. So these are specific things, income of entities that are exempt, and these specific things down here, and also, so that's exempt, and also non-A. So just as a quick recap, what's the difference between exempt and non-A income? So exempt income and non-A income, it's the impact on tax losses. So exempt income reduces tax losses. So if you're carrying forward, $100,000 of tax losses, and you claim $100,000 of exempt income, that's going to reduce your tax losses carried forward. Non-A income will not do that. Okay, so just coming back to this chapter, let's move on to specific deductions. So specific deductions are, so maybe it doesn't specifically fall under, you can't argue it falls under the general provisions to get this deduction, but you should always consider these specific deductions. And even if it does fall under the general deduction, in an exam, you should be referencing the correct section. So if there is a specific deduction that you should be claiming against, you'll need to know the correct section reference and use that one in an exam to get the proper mark. You can't just apply section 8-1 as a general fallback, although I would recommend, if you don't know, just to use section 8-1, the general one, and most of the time you will get a mark for it. Okay, so here are some commonly used specific deductions which you need to know about. So borrowing expenses. So this is a really common one. So these are things where you've taken out a loan and all of a sudden you have to pay insurance, survey fees, loan guarantees, valuation fees, etc. This falls under section 25-25. So the things you need to consider. Does this fall under Div 230? Now, Div 230 is something which doesn't come up in exams very often. It's quite specific, and we'll cover it later on once we get to this whole TOEFL and other financial arrangements. But generally, it's not going to fall under this. So these is generally what's going to happen here. So borrowing expenses is not Div 230. So we need to consider, is the total expenditure less than $100? If yes, then the entire amount is written off in the year incurred. So section 25-25-6. However, if the total expenditure is greater than $100, what you do is you actually apportion it over 5 years. So for example, if you've got a written off expense of you've got a borrowing expense of $2,500, it's over $100. Therefore, the annual expense would be $500. Annual deductions, would be $500 per year. And how you do that in a question and exam would be you'd add back the $2,500 and you'd subtract $500 for your tax calc. And you'd reference section 25-25-4-5. Okay. All right. And also you got to consider the purpose of it. So is the loan deductible? We go back to those previous steps. What was the purpose of the fund of the loan, and what was the use of the funds? And we have to apportion the borrowing expenses for that as well. Okay, so WIP is another specific one that you might see coming up in a tax rec question. So WIP is work in progress. And if you're working for an accounting firm, you'll probably be across this concept because we have to bill all of our time for jobs. So any job will have a WIP at any given point, which is basically all the hours billed to that account. So it's the work in progress. So if you're going to acquire a business for example, if one accounting firm, KPMG, is acquiring a smaller accounting firm, they're going to take on board all of their WIP. So they'd reimburse the vendor, the seller, for the work in progress. And payments for acquisitions of WIP are deductible in the year of acquisition if at the end of the income year a recoverable debt with respect to the WIP has risen or is expected to arise within 12 months after the WIP was acquired. Okay, it's very specific. If you see an exam question with the word WIP in it, think of this specific deduction. Repairs and maintenance. Now, this is a tricky one. So this goes back to this concept up here about capital versus expense in nature. So repairs and maintenance. So repairs and maintenance is it's an expense. So how is that different from a capital expenditure? Well, there's some case law which we can refer to, which allows us to determine whether something's CapEx or repairs and maintenance. So does it restore function? It improves function significantly, will be not deductible, i.e. CapEx. So for example, if you've got a roof that's fallen in, if we were to put in a new roof with the same features, it's going to restore function. However, if we were to install a new roof with a number of air lights, maybe a lift going up to the roof, this is going to significantly improve the function, therefore that's most likely CapEx. Okay, renews part of an asset. Okay, so instead of replacing the whole asset, we're just going to repair a section of it. For example, there might have been some tiles loose from a roof. Indicates it's repairs and maintenance when we're just repairing that section. However, if you're going to replace the whole roof, then this is most likely going to be a capital item and not deductible. Excuse me. Does not change character. Okay, so going back to the building example. So what is the character? So the character is the nature. It's quite similar to function, except function is what purpose it carries out. However, character might be the design, the features, etc. So for example, you might build, maybe your house burned down and you replaced it with the same house. The house maybe was a very basic house before, but now we're spending millions on an architect. We're going to have 3 levels. We're going to have a water slide, all kinds of things which kind of change the character of what the original asset was. This is therefore likely to be a CapEx if this changes the character of the item. And then, yes, okay, so replacement of entire asset. This kind of feeds into this, whether or not you're replacing part of an asset or an entire asset. If you're replacing an entire asset, it's most likely to be a CapEx. Okay, so prepayment rules. So there's another specific example. So there is a deduction for prepaid expenses that would otherwise be deductible when incurred under Section 8-1. So basically this is saying if you had applied the rules of Section 8-1, would this expense have been deductible? It's to be spread over a legible service period. For example, prepaid salaries and wages. So and there's another exemption to this rule for small businesses, which we'll cover on later. But generally, you get the deduction for the prepaid expense over the period that the expense is to be carried out, not when it's paid, right? There is a few exemptions. So one is small business. So which we'll talk about later, if it satisfies that, you get the deduction up front. The other exemption is prepaid salaries and wages, so that's deductible when the service is paid, not when it's conducted. Otherwise, everything else is deductible not when it's paid, but when the service is incurred. Okay, so here are the exclusions to the prepayments rules. I talked about a few of them. Right, so these are the exclusions from the PIPA, i.e. you get an immediate deduction when it's paid if one of these rules applies. If one of these rules do not apply, then we have to only get the deduction when the service is incurred, i.e. if it's done over 2 years, we get the deduction over 2 years. Okay, so expenditure that is deductible under specific deduction other than Section 8-1, e.g. tax return fees or any other ones. You'll get the hang of these later on once we've covered all of these. These will be deducted when paid. Amounts less than $1,000, i.e. net of input tax credit entitlements, i.e. net of GST, you get an immediate deduction. 3, individuals. If you're an individual and it's prepayment, if the service period is less than 12 years, then it's immediately deductible. For example, if you're an individual and you're paying for next year's tax return, you get that deduction when it's paid. Small business taxpayer, and we'll talk about this a lot more in detail when we get to that section. Prepayments are deductible when paid if the prepayment is for a service less than 12 months. Okay, so again, service period less than 12 months, deductible for small business. If you're a large business, however, this rule doesn't apply. So, the example I'm going to give you is one where we've got a company paying for next year's tax return services. In one example, we've got a small business. In another example, we've got a large business. In another example, we've got an individual. Right. So for the large business, the service is for next year's. So what we're going to do is because they're not eligible for these rules, and the amount is greater than $1,000, by the way. For the other tax, for the large company, they're going to get the deduction next year when the service is carried out. For the individual, they're going to get the prepayment deduction in the current year when they paid it, and same for the small business taxpayer, they're going to get a deduction when they pay for it. Okay, and number 5, so expenditure required by law. So, for example, workers' compensation, motor vehicle registration, CTV insurance, land tax, interest withholding tax, anything that's required by law, you do get an immediate deduction, even if it's even for a large company. And the last one here, which is the specific prepayment rule, is expenditure paid under service, i.e. employment, contract, you get an immediate deduction when paid. So we kind of mentioned this. Above there. Okay, all right. So let's move on to entertainment. Sorry, there's a long list of these. It's going to take a while to get through them. So let's move on to entertainment. So entertainment is specifically deductible except where provided as fringe benefit. Taxpayer's business is to provide entertainment. Is provided in provision of general goods and services to the public. Entertainment allowances are deductible, provided in in-house dining facility. Okay, so other specific deductions, I'm not going to go through these, just have a look through them. Generally, what we'll do in an exam is when we get a question which covers off a specific deduction, i.e. tax rec question, what we'll do is we'll refer to the tax deduction guide, which I've got in a download up above, and I'll post some videos in the exam question section about how to actually approach a question like this. So instead of memorizing all these specific deductions, what we'll do is we'll kind of think when we see it in the question, okay, that rings a bell, let's look that up. We'll quickly look that up and look at the section reference and see if it's deductible and when it's deductible, and that's how we'll approach this section. But feel free to read through these now for the purposes of your own understanding. Otherwise, let's move on to tax losses. So what is a tax loss? So a tax loss is basically when your assessable income is less than zero. Sorry, your taxable income is less than zero. You get a tax loss. And a tax loss, depending if you satisfy certain rules, you get to roll forward that tax loss into the next year and apply it against your next year's income to reduce your taxable income and pay less tax. Okay, so moving on. We talked about the relationship between exempt income and non-AN tax losses. So the difference between that we've already talked about, so we won't go through that again. And I think we will stop here because these are quite specific deductions, and we'll move on to the next video. But definitely the best way to really learn all of these is to go through some exam questions and use our deduction resource, which we'll talk about later. Anyway, let's move on to the next video, which will be trading stock.